Ray Dalio went all in on Europe's collapse. But is he winning? I'm your host, Steve Van Metre, and thanks for joining me today. And while Ray Dalio is betting big on the collapse of the European stock market, U.S. investors are betting big on a bear market rally. Who's going to be right? Well, let's head over to Bloomberg, where we picked today's story up as Bridgewater doubles the short wagers in Europe to $10.5 billion as a famed hedge fund manager has short positions against 28 firms, ramping those bets up here recently. All the companies that Bridgewater is shorting are part of the Euro Stoxx 50 index. The move comes as the euro area economic expansion is slowing, along with the global economy, as it heads sharply amid surging prices and Germany's warning that high gas prices could trigger a collapse in the energy market, which is pretty smart actual warning. Drawing a parallel to the role of Lehman Brothers in triggering the financial crisis, short sellers like Dalio try to profit from declining stock prices by selling borrowed shares and buying them back when they fell. They are mounting their bets at a time of rising interest rates and inflation that are increasing the chances of a recession. It's not clear whether those bets are aimed at pure profit or part of a broader hedging strategy. The question is he going to be right in the end? Well, I think he is, but in the short term, it looks like some pain's coming from Bridgewater because according to the data that we have, he was building those short positions and increasing them down here near the lows of the Euro Stoxx 50, and now as global investors, not just Americans, are getting bullish that the worst is behind us. Well, for short sellers, it doesn't look good. But is the party over for Bridgewater? Well, probably not, as the billionaire Ray Dalio warns that U.S. can't keep spending and bring down inflation. He says that money is going to get a lot tighter while assessing the Fed's inflation response. And he notes that during a recent interview on Friday, that he provided insight on the U.S. economy amid record inflation rates, predicting the Federal Reserve's quantitative tightening will run its course in about 18 months. And if actually that would be good news, because the longer the Fed does quantitative tightening, the more likely it's going to be to pull liquidity out of the markets and put downward pressure on the stock market. In fact, much of what we're seeing in the stock market today, in terms of how much it's been down this year, is likely due to the Fed draining liquidity. And the Fed's continuing that with a big increase set for September. The question, though, is Mr. Dalio, or as may I call him Ray, is he right? Well, let's take a look, because what we're seeing right now is the yield curve, as we're going to see here in red, and that is when you take 10-year yields and you subtract 2-year yields, and when it's inverted or below this hastily drawn yellow line that I have on your screen, it means that 10-year yields are less than 2-year yields, which is abnormal in the bond market. It shouldn't happen. Well, I want to note, going back before the great financial crisis, what did we see? A yield curve inversion here. And what happened shortly thereafter is quantitative easing 1, 2, and 3. We see another inversion just before the pandemic. And what did we get? More QE. We have another inversion now, kind of indicating that perhaps less than 18 months, well, Mr. Dalio may get his wish, and the end of QT will be here. He goes on to say in that interview that you have an 8% inflation rate, and look what people get. And we're talking now about a 3% interest rate. And people think that's good, right? Well, it might be better than you think. So you're going to lose money and lose buying power. He says he thinks inflation will come down a bit, but it's going to be very high and money is going to get a lot tighter. So you're going to have stagflation. Well, if you have tight money, that means inflation is going to come down. But here's the proof that not only inflation coming down, it's coming down a lot more than he thinks, making perhaps that 3-year interest rate or 3% interest rate look pretty good. Now, first, let's overlay the consumer price index in blue on a year-over-year rate of change. We're going to keep that same yield curve chart, and I've got that same hastily drawn yellow line showing where the yield curve inverts, and I've circled here points where it has inverted or has inverted several times, and note, look what happens. Consumer prices came crashing down in the early 80s, and it inverted again in the late 80s. And what happens sometime thereafter? The consumer price index came crashing down, and we have an inversion just before the dot-com bubble. And what happens? Of course, inflation came down. We have another inversion before the great financial crisis. We see the CPI continue to press higher. Then it came crashing down. Another inversion before the pandemic. Inflation came down. We have another inversion now suggesting that, in fact, inflation is coming down, but perhaps a lot more than Ray thinks. And of course, for interest rates, that's good news because where inflation goes, interest rates follow, telling us that rates are indeed headed lower. And we can see that here because now let's take a look at the stock market and try to figure out, is Ray going to be right? Well, if we look at, or of course, the bigger question is, who is right? Is Ray right? Or are U.S. investors or all these global investors that are buying this dip going to be right? Well, the yield curve says not so fast. Check this out. Here again, we have the yield curve. And now without that yellow line drawn in, I've just circled the inversions. And I want to note that where we see these inversions happening, look what happens to equity prices as I've overlaid the Wilshire 5000 price index or the total U.S. market. It goes down. And here you see an inversion followed by lower stock prices. Inversion, lower stock prices, inversion, and what do we kind of expect now to happen is stock prices to go down and interest rates to go down as well. And if you're concerned at what that means for your portfolio, well, you shouldn't be, because there is a strategy out there that hedges the market downside risk and does it with bonds, and that's Portfolio Shield. I'll put a link up here in the corner and description below. And while you're down there in description, if you want to further your education on what this yield curve thing means, because policymakers tell us it's meaningless, but well, there are other people like my partner and chief strategist, Jeff Snyder, who had a lot to say about it. I went and visited him on his show with Emil Kalinowski to talk about that very subject. I'll put a link to that show below. If you want to take your education to the next level, well, be sure to tune into their channel. As we head over now to the Wall Street Journal, who notes that consumer spending grew at a much faster rate in June as it rose 1.1% as inflation accelerated. But the bad news is incomes didn't keep pace with it, as we see personal income rose by 0.6% last month, the same as the month before. And what that tells us, and this is not unusual for Americans, is that spending is outpacing incomes. So where is all that other money coming from? Well, it can come from savings, or more importantly, it comes from credit cards, as Michael Burry warned on our show yesterday, that overuse of credit is going to lead and cause part of the next crash that's coming. The Wall Street Journal goes on to say that personal consumption expenditures, the Fed's preferred gauge of inflation, rose 6.8% in June from the year before, up from the 6.3% increase in the 12 months through May. The core, which strips out the volatile food and energy components, rose by 4.8% in June, up slightly from 4.7% in May. On a monthly basis, core prices rose a seasonally adjusted 0.6% in June from a month earlier, a sharp pickup from the 0.3% increase the month before. But what we're noticing here on this chart that compares the PCE in red against the core, again stripping out food and energy in blue, we can note that the core tends to lead where the broad inflation goes, and we could be seeing a peak here in the core coming in and a downward trend beginning. Of course, trends are going to take more than a couple months to actually see, but this could be a leading indicator now of where inflation is headed. But of course, we already know that because the yield curve tells us that inflation is coming down, rates are coming down, and so too are stock prices. But Dalio mentions that we can't keep inflation down unless governments stop giving out money. Well, Ray, maybe that's not the case because governments aren't giving out enough money. Here we see the real disposable personal income data just came out Thursday. Is negative, so it's showing that on an inflation-adjusted basis, even after government transfers, people have less money. So governments aren't giving people enough money to keep prices persistently high. And so perhaps more evidence that Ray is going to be right and the stock market's going to go down, and that evidence is in the personal savings rate, which continues to sink. Now, if you're wondering, what is this personal savings rate? According to the government, it may be generally be viewed as a portion of personal income that is used to provide funds to capital markets or to invest in real assets such as residence, or simply stated, the money you have left over every month to actually invest. Doesn't mean you do, but you could. And it's worth noting The periods in blue where you see the personal savings rate, and I've highlighted in yellow, are at fairly low levels or trending down from higher levels. When we overlay the Wilshire 5000, again, the total U.S. stock market on a year-over-year rate of change, you can see that as less money is available for investing, that the market tends to come down following those periods, and that kind of supports perhaps the Ray's view that the European market's headed down and the U.S. investors may be totally wrong. And another thing that is driving the equity market lower is broad sentiment. We had the University of Michigan Consumer Sentiment Survey. It was virtually unchanged from the month before. And we've talked about this in the past, that sentiment is actually key because it tells us where asset prices are going, and it also tells us where interest rates are going, because they also do a survey for that. But let's take a look at this chart, because we've got the University of Michigan Consumer Sentiment Survey in blue, and I want to note that it's not until sentiment bottoms, and we've got the Wilshire 5000 now in red, where sentiment bottoms, you see a bottom in stock prices. So here you can see following the dot-com bubble, bursting, sentiment bottoming, stock prices. Here you see the great financial crisis, sentiment bottoming, stock prices. Here you can see the pandemic, sentiment and stock prices. Here you see sentiment at, well, extremely low periods. And that's what investors are looking at. They're saying, hey, it can't get worse. It may not get worse. In fact, it may get a little bit better, but as long as it stays low and in that general area, it's going to put downward pressure on the equity markets, and that means the risk to the equity markets is the downside, certainly not to the upside. But let's take a look at these inflation expectations, because we're seeing them start to slow down and roll over. And while that is not the best gauge for where interest rates go, we have seen in the past periods where, and I've highlighted in blue, where sentiment is rolling over on inflation expectations. When we overlay 30-year treasury yields, we see that that tends to mark periods where rates have also peaked or have recently peaked, and we see that throughout history. There's not a ton of data points here to suggest that, but there are more than enough. There's only a few places here where we see actually inflation expectations rising and yields continue to rise, but then they head lower, suggesting that perhaps the peak in interest rates may be already in. Now, you don't have to be a PhD economist to actually understand inflation expectations. If you just drive a gas-powered car, you probably already get it. And here's why. Because when we take inflation expectations and we overlay gas prices, here you see U.S. regular, all formulations, gas price in red. Well, where gas prices go, inflation expectations follow, telling us what we already know now is that the equity market's likely to come down. Ray's going to be right about that. Most other investors are going to be wrong. Inflation's coming down, and rates are coming down with it, and that is how we know we're headed into another crisis. I'm your host, Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.